Hi, everybody. So the semester's almost over. We're on chapter 9. I'm going to talk about just one problem from chapter 9 since we're not covering most of the chapter. Um, Number one, because we just don't have time to cover every single thing that's in this book. I think we've done quite enough work this semester. And also, just some of the stuff that's in chapter 9 kind of belongs in a payroll class, which I know that Normandale does not offer at this time. I think it would be kind of cool if they did. So, any of you that are really interested in that, maybe send the dean an email and let him know that that's something that you would be interested in. Century has a payroll procedures class that's offered as part of their accounting program. So, if it's something that you're really itching to take, then feel free to take a class over there. Okay, the one problem that I want to cover for chapter 9 is problem 17. And I'm doing the problem that's in the book, and then the problem that you're going to do just has different numbers in it. This problem is very simple, but I like to always do at least one or two problems with you for every chapter. So here with this problem, we have Telly, age 37, has a $140,000 IRA. And it's important to note here that this is an IRA because the rules are different. Whether something is an IRA or an employer's qualified retirement plan. He's read good things about the management of Green Mutual Fund. So he opens a Green Fund IRA. So he's wanting to move his money from one IRA to another IRA. Telly asked for and received his balance from the Blue Fund on May 1st, 2018. Telly opted to have no withholding on the distribution. And that's another piece of information that's really important too. Because it's an IRA, you'll remember from your reading from this chapter that there's not a requirement of the 20% withholding when it's an IRA. So he got to have the choice. Since he planned on moving the money from one IRA to another IRA, there was no reason for him to want to have any withholding. So what is the total amount that Telly will receive? He's going to receive the entire $140,000 because there's no withholding. What amount must Telly contribute to his new IRA to avoid having taxable income and penalties for early withdrawal? So he has to put that entire $140,000 into his new IRA. He doesn't get to take some of it and go on a vacation or buy a new car. He certainly could. That's an option for him, but it's not going to be a wise option when it comes to taxability. He would end up having taxable income for whatever amount he didn't contribute to the new account, and then also he would end up paying penalties. So not the best thing to withdraw money from an IRA and have to pay those penalties unless you have an extreme circumstance. You know, you've got to have them for medical expenses or something like that. Part C, when is the last day Telly could roll over the amount into his new IRA? So he has 60 days, and I'm sure you remember that from your reading in the chapter. So that would be June 30th. He has to do it pretty quickly. And then part D, what amount will Telly initially receive if the distribution were from his employer's qualified retirement plan? So if it was his employer's qualified retirement plan, then they are required to withhold that 20%. So he would only get 80% of the money. So if we put in our calculators, just getting my calculator opened up here. So 140,000 times 80% or 0.8, because that's the amount he's going to get. The other $20,000 the company would be required to withhold. So $112,000. And that's it. You only had two problems from chapter 9. And in my next video, I will cover just a couple things from chapter 12, and then we'll be done with all of our learning for this course.